Well, howdy there, Internet people. It's Belle again. So today, we're going to talk about the stock market versus the economy and ignoring signs. So, we got a question that really gets to the root of a big misunderstanding, and it can help explain what the stock market is and isn't a good gauge of. So here's the question. So I'm confused about something. I see a lot of people warning about corrections or even crashes when it comes to the stock market. You were the first one to say something, so I'm going to ask you. This week, it became clear that interest rate cuts weren't going to happen fast. New tariffs were coming, and inflation is going up. These are all things that are supposed to be bad for the economy, but the stock market didn't crash or correct. In fact, it went up. I don't understand. Okay, so when watching the news, it's often portrayed as if the stock market is a measure of the actual economy. It isn't. Even when performing on fundamentals in an ideal way, the stock market is a mechanism for investors to buy pieces of a company, and the expectation is based on future returns, not the state of the economy right now. The stock market can be somewhat disconnected from the real economy, which is best measured by the gross domestic product, wages, and employment. What you're pointing to is evidence of this. The market is severely overvalued. Currently, the market is valued around 209% of the GDP. That's a record high and indicates that people are investing based on emotion, or maybe some are trying to time it and hoping to get what they can and get out before it corrects. The fact that the market gained while the news was universally not great shows that disconnect is in full swing and emotion is driving a lot of investment. It's not a term I like, but the term that gets used for this is animal spirits, if you want to look into it more. At some point, the fundamentals, like price to earnings and the general state of the economy, start to weigh on the market. Then something shakes it. It could be dropping consumer confidence. It could be the broad application of tariffs, etc. That's when you see the correction. While a stock market isn't the economy, it can't be ignored, even if you're not in the market. Because when corrections or crashes happen, it impacts the real economy as companies try to protect their stock price via what they'll call cost-cutting measures. A lot of times, that means jobs being cut or reducing planned expansions. The state of the market is fragile. In fact, expect to start hearing that term a lot in normal news coverage, market fragility or stock fragility. That'll start showing up in non-stock news. The economy achieved its soft landing, but a lot of uncertainty has been introduced by the new president, which leads it to be more at risk. I hope this helps clear it up. Not every piece of bad news will trigger a correction. The bulls will charge right through a whole lot of bad news. But historical evidence indicates a correction is coming. Anyway, it's just a thought. Y'all have a good day.